Welcome to another Explainer, where we dive into the hidden forces driving the stock market today. If you've ever felt like the financial markets are playing by some secret, hidden set of rules, well, you're in exactly the right place. Let's get right into it.
Let me ask you a quick question to kick things off. Have you ever wondered why a massive company can report millions or even billions in record profit, absolutely crushing all expectations, yet its stock price still completely tanks the very next morning? It feels totally backwards, right? No way that makes sense.
To a lot of us, the market often just looks like a chaotic illusion. It's this confusing noise of rapid fluctuations, flashing red and green numbers, and charts zigzagging for literally no apparent reason. To put it in super simple 10th grade terms, the surface of the stock market is essentially just a giant, messy crowd of people shouting their opinions at each other. But here's what most people don't know. Underneath all that shouting, there's actually a very real, very logical foundation.
Okay, let's dive into Section 1, the mechanics, bids, asks, and market makers. Before we can even begin to understand the psychology of it all, we really have to understand the mechanics. So let's strip away all the complicated jargon for a second. The stock market is, at its core, simply a massive, high-speed digital auction. On one side, you've got the bid price. This is the absolute maximum a buyer is willing to pay. On the other side, you've got the ask price. This is the absolute minimum a seller is willing to accept. The entire market is just millions of buyers and sellers constantly trying to find a price they can both agree on.
But wait, what happens when the buyers and sellers just don't agree? Well, enter the market maker. A market maker is essentially the ultimate middleman of the financial world. It's a firm that continuously quotes both a buy and a sell price. They literally stand ready to take the other side of your trade at any moment. And they make their money on that tiny little gap, the spread, between the bid and the ask. They're the ones providing the exact liquidity that keeps this giant machine moving day in and day out.
Let's look at a real-world example using Amazon stock. Imagine the absolute highest a buyer wants to bid for a share is $25, but the absolute lowest a seller is asking is $28. So they negotiate. Maybe they go through those market makers we just talked about. And finally, they meet right in the middle. Boom. A trade executes at $25.70. And that right there becomes the last price. That $25.70 is the exact number you see flashing across the ticker on your screen. It's just a snapshot of the very last agreement made.
Section 2. The madness. Fear, greed, and emotion. Okay, so that explains the math, right? But what explains the wild swings, the real madness? Why do those bids and asks jump so wildly from day to day? Well, the answer actually isn't in a finance textbook. The answer is biology.
Think about the CNN Fear and Greed Index. It's this fantastic tool that distills massive amounts of market data into one simple score from 0 to 100. When the market is sitting in that 0 to 24 range, we're looking at extreme fear. People are just panicking, dumping their stocks. But when it swings all the way up to the 75 to 100 range, we hit extreme greed. Investors get completely euphoric and just start buying everything in sight. The market price at any given millisecond is heavily dictated by exactly where we're sitting on this emotional scale.
There's this incredible quote from Stansberry Research that hits the nail on the head. The risk of losing money triggers the very same fear response in people today that struck our ancestors when they saw a lion out on the plain. Think about that for a second. Panic selling isn't some calculated financial move. It's a raw biological survival instinct. When your portfolio turns completely red, your brain actually literally thinks you are in physical danger.
And it gets even crazier when we introduce the close cousin of fear, pure uncertainty. You see, markets can handle bad news, but they absolutely hate uncertainty. Things like sudden drops in corporate guidance, unexpected, shocking news headlines, unpredictable policy actions, like new tariff proposals, for example. All of these things inject massive amounts of uncertainty into the system. And here's the thing, regardless of what side of the political aisle you're on, when executives and investors just don't know what the rules of the game will be tomorrow, they freeze, they pull their money out, and they wait. And that freeze, that's what causes the market to suddenly drop.
So, we know the emotions are there, but how does this actually play out, say, on a random Tuesday afternoon? Let's get into Section 3, the intraday move, an anatomy of volatility. Let's break down step by step how a stock reacts to a surprise. Step 1, the news hits the wire. Let's say it's an unexpected earnings miss. Step 2, intraday sentiment shifts immediately. We're talking algorithms and day traders reacting in literal milliseconds. Step 3, that biological fear and greed we talked about, it kicks in hard.
This sparks massive intraday volatility as the bid and ask spreads suddenly widen way out. And finally, step 4, the dust eventually settles. The stock enters what's called a post-earnings drift, taking the next 60 to 90 days to just sort of adjust to its new reality.
The absolutely crucial point here is just how violently fast this reaction really is. Our source data shows that a negative earnings surprise can trigger a massive 5 to 15% price decline within just 24 hours. I mean, really think about that. The actual physical factories, the products, the thousands of employees at the company, they didn't suddenly lose 15% of their capability overnight. No way. But the raw emotion of the crowd completely repriced the entire asset by 15% in a single day.
Moving right along to Section 4, the iceberg. Misconceptions of price versus value. This is where we really have to separate the surface noise from what truly matters in investing. You absolutely, fundamentally must separate price from value. Price is strictly short-term. It's driven by the latest social media narrative, fear, greed, perception, the whole shebang. But value? Value is long-term. It's driven by actual cash flow, true competitive advantages, and solid business fundamentals. Just look at real-life examples like GameStop and AMC during that whole meme stock frenzy. Social media hype and herd behavior drove the price of those stocks straight to the moon. But the actual value of those businesses, their real revenues and profits, they were incredibly weak. The price completely detached from the actual value.
Blurring those lines between price and value leads to basically all the most common beginner mistakes in the market. Mistake number 1, panic selling at the absolute bottom because you mistakenly think a falling price means the company is permanently broken. Mistake number 2, believing a rising price automatically means a company is super healthy, and the absolute biggest trap of all, chasing social media hype without ever once opening up the company's financial statements to check its real fundamentals.
The renowned behavioral investor James Montier perfectly summed this whole thing up. He said, "You are your own worst enemy." Our survival instincts make us prone to all sorts of errors. It's so true. Our brains literally wire us to buy at those euphoric speculative peaks when it just feels safe. And, on the flip side, they wire us to sell at the terrifying market bottoms, which is exactly when stocks are actually on sale.
And this brings us to Section 5, the masterclass, the ultimate investor takeaway. If you actually want to successfully navigate this totally chaotic digital auction, you've got to shift your entire mindset.
Try to think of the stock market as a giant iceberg out in the ocean. The waves crashing wildly on the surface. That's the price. It's noisy, it's turbulent, it changes every single second, based entirely on the weather of human emotion. But beneath the surface, that's where the value lies. It is massive, it is stable, and it changes very, very slowly based on real-world business performance.
And here is the core insight you need to remember. It comes from one of the absolute most famous maxims in financial history. In the short run, markets act as voting machines. In the long run, they are weighing machines. Let that sink in. In the short term, the market is basically just a high school popularity contest. But over a 5 or 10-year horizon, the market acts as a scale. It heavily weighs the true fundamental cash flow value of a company. Hard numbers will always ultimately dictate the long term.
So as you look at your own investments today, I'm going to leave you with this provocative thought. Moving forward, are you going to let the daily panic and euphoria vote on your financial future? Or are you going to let long-term, hard fundamentals weigh your portfolio for lasting success? If you enjoyed this breakdown, make absolutely sure you hit that subscribe button to catch our next explainer. We're going to keep cutting right through all the noise to bring you the insights that actually matter. Thanks so much for joining me, and I'll catch you in the next one.